For the better part of a century, the global financial system has operated on a single, unquestioned assumption. The United States dollar is the safest asset on Earth. It was the exorbitant privilege that allowed the U.S. to print money without consequence, knowing that there would always be a buyer for its debt. Central banks from Beijing to Brasilia hoarded U.S. Treasury bonds like precious artifacts, believing that in a crisis, the dollar was the only true refuge. But in 2022, that assumption was shattered, and the aftershocks are now threatening to dismantle the American financial empire. We are witnessing a geopolitical divorce of historic proportions. The nations of the BRICS bloc, Brazil, Russia, India, China, and South Africa, now expanded to include major energy producers like Iran and the UAE, are systematically unplugging themselves from the Western financial grid. They are dumping U.S. government debt at a record pace and replacing it with the only asset that has no counterparty risk: gold. To understand why this is happening, you have to look back at the moment the weaponization of the dollar became official policy. When Russia invaded Ukraine, the United States and its European allies took a step that had never been taken against a G20 economy before. They didn't just sanction trade, they froze over $300 billion of Russia's sovereign central bank reserves. Overnight, money that belonged to the Russian people, sitting in accounts in New York, London, and Brussels, was effectively confiscated. For Washington, this was a shock and awe tactic designed to cripple the Russian war machine. But in capitals like Beijing, Riyadh, and New Delhi, it was received as a terrifying wake-up call. The message was clear: your dollar reserves are not yours. They are merely a permission slip from the United States Treasury. And that permission can be revoked the moment you disagree with American foreign policy. If the U.S. could seize the savings of a nuclear-armed power like Russia, what chance would a smaller nation have? The risk-free asset has suddenly become the high-risk asset. The reaction was immediate and coordinated. China, the largest foreign holder of U.S. debt, began a fire sale. For years, China held over $1 trillion in U.S. Treasuries. Today, that number has plummeted to its lowest level since 2009, creating a massive hole in the market for American debt. But China isn't just selling, it is refusing to buy new debt. This is happening at the exact moment the U.S. government is issuing trillions in new bonds to fund its deficits. When the biggest buyer leaves the auction, the seller has a problem. But if they aren't holding dollars, what are they holding? The answer is buried in the vaults of the People's Bank of China and the Central Bank of Russia. 2024 and 2025 have seen the most aggressive central bank gold buying spree in history. China officially added to its gold reserves for 18 consecutive months, though many analysts believe the true numbers are far higher, concealed to avoid panicking the market. They are trucking physical bars out of Switzerland and London and moving them into vaults in Shanghai. This pivot to gold is not a traditional investment strategy. It is a national security strategy. In a digital financial world controlled by SWIFT, the messaging system that underpins global banking, the U.S. has the power to turn off a country's economy with the flip of a switch. Gold is the only analog off switch. It cannot be hacked. It cannot be frozen by a sanctions decree. It cannot be devalued by a Federal Reserve chairman printing trillions of new dollars. It is sovereign. By accumulating gold, the BRICS nations are building a financial kill switch, a war chest that allows them to trade outside the dollar system if the geopolitical Cold War turns hot. This trend is accelerating because of the internal economics of the BRICS alliance. These nations are no longer the emerging markets of the 1990s. Collectively, the expanded BRICS bloc now controls a massive share of the world's natural resources. They have the oil, Saudi Arabia, UAE, Iran, Russia. They have the manufacturing, China. They have the agriculture, Brazil, Russia. They have the tech workforce, India. For decades, if Brazil wanted to sell soybeans to China, the transaction happened in US dollars. Brazil would convert real to dollars, China would pay in dollars, Brazil would convert dollars back to real. The U.S. banking system took a cut of every step, and the U.S. government gained leverage over both nations. Today, that trade is increasingly being settled in UN or national currencies. The petrodollar, the agreement that oil must be sold in dollars, is dying a death by 1,000 cuts. Saudi Arabia is openly discussing trading oil in UN. India is buying Russian oil in rupees and dirhams. This brings us to the ultimate goal, the BRICS unit. While still in the developmental phase, BRICS leaders are actively discussing a common trading currency or a digital settlement mechanism backed by gold and a basket of commodities. Unlike the euro, which is a fiat currency backed by nothing but promises, this proposed system would be anchored to real-world assets. The theory is that a currency backed by gold and oil is inherently more stable than a currency backed by $35 trillion of debt and a militarized foreign policy. The implications for the average American are profound. The standard of living in the United States is artificially inflated by the dollar's reserve status. Because the world needs dollars to trade, there's an insatiable demand for the currency. This allows the U.S. government to borrow cheaply and allows American consumers to buy imported goods for pennies. If that demand evaporates, if the BRICS nations succeed in building a closed-loop system where they trade resources among themselves without touching the dollar, the flood of dollars will come rushing back home. This is the economic equivalent of a dam breaching. The trillions of dollars currently circulating overseas would flood the domestic U.S. economy, triggering a wave of imported inflation that would make the post-COVID price hikes look mild. The cost of borrowing would skyrocket because without China buying treasuries, the U.S. would have to pay much higher interest rates to attract lenders. The BRICS strategy is not to destroy the dollar overnight. That would hurt them too, as they still hold significant dollar assets. Their strategy is to slowly bleed the beast. They are building a parallel financial architecture, brick by brick, gold bar by gold bar, until they reach a tipping point where the dollar is just one of many currencies, rather than the sun around which the global economy orbits. The king dollar era is ending not with a bang, but with the quiet sound of gold bars stacking up in a vault in Beijing. To understand how the BRICS nations plan to dismantle the US dollar's dominance, you have to look past the speeches and look at the plumbing. The global financial system is essentially a series of pipes that move money from one country to another. For 50 years, the United States has owned the pipes. The most important pipe is SWIFT, Society for Worldwide Interbank Financial Telecommunication. Technically, SWIFT is just a messaging system. It doesn't move money, it sends the instructions to move money. But because almost every major bank in the world uses it, and because the US dollar is involved in nearly 90% of global trade, the United States has a god's-eye view of the global economy. They can see every transaction, and more importantly, they can block every transaction. When the US wants to sanction a country like Iran or Russia, they simply unplug them from SWIFT. It is the financial equivalent of cutting off a country's oxygen. But the BRICS nations are no longer trying to fix the old pipes, they're laying new ones. The most dangerous threat to the US dollar is a project that most Americans have never heard of. Project mBridge, launched by the central banks of China, Thailand, the UAE, and Hong Kong, and recently joined by Saudi Arabia in June 2024. mBridge is a digital platform that allows central banks to send money to each other directly. In the current system, if Thailand wants to buy oil from the UAE, they usually have to convert Thai baht to US dollars, send the dollars through a US correspondent bank in New York, and then convert them to UAE dirhams. The US sees the trade, regulates the trade, and takes a fee on the trade. With mBridge, the Thai central bank simply sends digital tokens directly to the UAE central bank. No US dollars, no US banks, no US surveillance. This is not just an alternative, it is the financial stealth bomber. It creates a dark pool of global trade that Washington cannot see, cannot sanction, and cannot control. But new plumbing is useless if you don't have anything to put through it. This brings us to the second pillar of the strategy: energy. The US dollar's superpower status rests on a handshake deal made in 1974. In the midst of an oil crisis, Henry Kissinger struck a deal with the House of Saud. The US would provide military protection and weapons to Saudi Arabia. In exchange, the Saudis agreed to price every single barrel of oil in US dollars. This was the birth of the petrodollar. It forced every country on Earth to hold dollars so they could buy energy. It created an artificial, permanent demand for American currency. That deal effectively expired in June 2024. Saudi Arabia, now a full member of the BRICS alliance, has signaled a historic pivot. They are no longer exclusively married to the dollar. They have begun accepting Chinese yuan for oil exports. But there is a catch. The Saudis don't actually want to hold billions of yuan. They know that China prints money just as fast as the US does. So China offered them a solution: the Shanghai Gold Exchange. The mechanism is simple: gas for gold. Saudi Arabia sells oil to China. China pays in yuan. Saudi Arabia immediately takes that yuan to the Shanghai Exchange and converts it into physical gold bars.
This allows energy producers to bypass the dollar completely and store their wealth in a hard asset, while allowing China to buy energy with its own printed currency. This brings us to the final piece of the puzzle, the unit. The BRICS nations know that they cannot trust each other's currencies. The Brazilian real is volatile. The Russian ruble is sanctioned. The Chinese yuan is capitaled. They need a neutral reserve asset. In late 2025, pilot programs began for a new trade settlement currency, tentatively dubbed the unit. Unlike the euro or the dollar, which are backed by nothing, the unit is proposed to be backed by a basket of commodities, 40% gold and 60% local currencies. The goal is to create a currency that derives its value from stuff, energy, metals, food, rather than from the creditworthiness of a government. This is a direct philosophical challenge to the Western debt-based model. The West produces services, finance, tech, consulting. The BRICS produce real assets, oil, wheat, gold. The bet they are making is that in a chaotic world, he who owns the resources makes the rules. To prove they're serious, these nations are doing something that hasn't been seen since the era of Charles de Gaulle: repatriation. They are taking their gold home. For decades, many developing nations stored their gold reserves in the vaults of the Bank of England or the New York Federal Reserve for safekeeping. But after seeing Russia's assets frozen, trust has evaporated. In 2024, nations like India, Nigeria, and Saudi Arabia began quietly moving tons of physical gold bars out of London and New York and back to vaults in Mumbai, Abuja, and Riyadh. They are preparing for a world where possession is 9/10 of the law. They are building a fortress economy, insulated from the US financial system, armed with gold and powered by their own energy. In the final section, we will ask the trillion-dollar question: what happens to the United States when the world stops buying its debt? We will look at the Triffin Dilemma coming home to roost. When the demand for dollars collapses, those dollars have to go somewhere. They will come flooding back to the American domestic economy. We will analyze the potential for a hyperinflationary depression and why the US government might eventually be forced to do the unthinkable: issue a new gold-backed dollar of its own to restore trust. We have explored the what, the weaponization of the dollar, and the how, the BRICS gold strategy. Now we must face the terrifying then what. What happens to the United States when the music stops? For 80 years, America has exported its inflation to the rest of the world. We print dollars, send them abroad to buy cheap goods, and those dollars stay overseas in the vaults of foreign central banks. It is the greatest economic magic trick in history. But if the BRICS nations succeed in building a closed-loop system where they no longer need greenbacks to trade, the flow reverses. This brings us to the Triffin Dilemma coming home to roost. When the demand for dollars collapses, those trillions of unwanted dollars have to go somewhere. They will come flooding back to the American domestic economy like a tsunami. Imagine a scenario where China, Saudi Arabia, and Brazil decide to liquidate just 20% of their dollar holdings to fund their new unit currency. That is trillions of dollars chasing a fixed amount of goods in the US economy. The result would be imported hyperinflation. We're not talking about 8% or 9% inflation. We are talking about a scenario where the cost of imported goods, electronics, clothes, car parts, doubles or triples overnight. The standard of living in the United States, which has been subsidized by the rest of the world for decades, would collapse to match its actual productive output. The exorbitant privilege would become the exorbitant burden.
To attract lenders, the U.S. Treasury would have to raise interest rates to 15% or 20%. This would instantly bankrupt the U.S. government, which is already paying $1 trillion a year in interest. The Federal Reserve would be forced to print the difference, creating a feedback loop of printing and inflation that destroys the middle class. The nuclear option: a new dollar. So how does it end? History tells us that when a fiat currency loses the trust of the world, there's only one way to restore it. You have to anchor it to something real. There are quiet whispers in Washington and Wall Street that the U.S. is preparing a contingency plan for this exact nightmare. It involves the one asset the U.S. still has more of than anyone else: gold. Officially, the U.S. holds over 800 tons of gold, the largest reserve in the world. In a crisis where the dollar is hyperinflating, the president could announce a monetary reset. They could revalue gold from $2,500 an ounce to, say, $50,000 an ounce. Overnight, the value of the U.S. gold reserves would skyrocket, creating a massive asset on the Treasury's balance sheet that could be used to back a new dollar. This would restore global trust instantly. The world would trust the dollar again because it would be as good as gold. But there is a catch, a terrifying catch. Many experts believe the US doesn't actually have the gold anymore. The US gold reserves have not been fully independently audited since the 1950s. There are rumors that the gold has been leased out, swapped, or encumbered to suppress the price. If the US attempts a gold reset, and the vaults at Fort Knox are found to be empty or filled with IOUs instead of metal, the game is over. The US would lose its superpower status overnight, and we would enter a chaotic multipolar world where regional warlords control the global economy. This brings us to the most dangerous realization of all. If the US government decides to remonetize gold to save the system, they will need every ounce they can get. They won't just want the gold in Fort Knox, they will want the gold in your safe. They have done it before. In 1933, faced with a similar deflationary crisis, the government didn't ask nicely. They criminalized the competition. Franklin D. Roosevelt signed Executive Order 6102. He ordered every American citizen to hand over their gold coins, bullion, and certificates to the Federal Reserve. The verdict? The BRICS nations are betting on gold because they know the math does not work for the dollar. They're exiting the burning theater while the exits are still open. You have a choice. You can trust that the politicians will fix the $35 trillion debt problem, which they won't, or you can become your own central bank. The window to act is closing. The great wealth transfer has already begun. The only question is, will you be the donor or the recipient? We've just talked about the possibility of a new gold standard, but most people don't realize that the last time the US moved toward gold, they didn't do it by buying it on the open market. They stole it from their own people. The story of the 1933 gold confiscation is the most censored chapter in American economic history. It involves secret prosecutions, decoys used by the FBI to entrap citizens, and a Supreme Court case that effectively ruled that your property is not actually yours. In the next video, we are going to tell the full, uncensored story of the Great Gold Seizure. We will explain exactly how it happened, how the wealthy escaped it, and the specific legal loopholes you need to know about today to protect your Bitcoin and gold from Executive Order 6102. You need to know if your safe is actually safe. Smash that like button to keep the signal alive, and subscribe so you don't miss the history of the gold ban. I'll see you in the